Welcome to Investment Ideas. I'm the host today, Ed Harrison, and I have the distinct pleasure of speaking again to Gary Shilling, who's the president of A. Gary Shilling. Gary, welcome to Investment Ideas.
Glad to be with you again, Ed. Thanks.
Welcome back, I should say. And for those of you who are watching who don't know your work, why don't you give us a brief explanation of the various things that you do at your company?
Well, we're economic consultants and also registered investment advisors. We eat our own cooking. We invest according to our views. We start with the aggregate economy. We look at the political, the economic, the financial spheres, develop a forecast, and then see what investment themes drop out of that. And they can involve any number of vehicles: stocks, long or short, bonds, currencies, commodities, whatever seems to be the best way of making money. And I've always been guided by two very fundamental principles. One is that history is relevant, that human nature doesn't change very rapidly, if at all. So people react to similar circumstances in similar ways. Now, Mark Twain said, history doesn't repeat, but it rhymes. But I'm always looking for areas where there are similarities, and that stood us in good stead in the past. Certainly with the big housing boom and collapse, with the Great Recession. The second principle is the conviction that you don't add value in this business by rehashing the consensus. That's already fully discounted. It's available in the media, the press. Where you add value is by finding things that are, first of all, likely to happen. They can't be trivial. Secondly, that are not yet within the purview of the consensus. And third, that are likely to be, that they're going to work out. And when we find those kind of things, we really jump on them with all fours. So that's the approach. We're macro. We're interested in the big picture: interest rates, consumer spending, capital spending, and obviously now the effects of the virus and so on. We're not stock pickers. We're not on that level. We're looking at the more aggregate measures of the economy and financial markets.
You know, that is a really exciting introduction, because there's so many places we can go with that. You know, actually, I was thinking about the fact I'm looking over at my bookshelf. I don't see it immediately, but I have one of your books with regard to the deflation. I think it was something regarding the age of deflation. And so when you talk about non-consensus views, number one, that was a non-consensus view. Number two, I know that potentially that view could be changing. And number three, we're in the middle of what I would consider a developing mania, potentially. And so my question to you is, what is the consensus view getting wrong right now about what's happening in the economy and in the markets?
Well, the consensus view is that the economy is going to open very rapidly, and that inflation is going to come roaring back. Interest rates are going through the roof. Now, I think that is way overdone. And by the way, and I've heard that since in the early 1980s, when the yield on the 30-year Treasury was 14.6%. It's now 2%. And you've had an unbelievable...
Hi, I'm Raoul Powell. Sorry to interrupt your video, I know it's a pain in the arse, but look, I want to tell you something important. I can tell that you really want to learn about what's going on in financial markets and understand the global economy in these complicated times. That's what we do at Real Vision. So this YouTube channel is a small fraction of what we actually do. You should really come over to realvision.com and see the 20 or so videos a week that we produce of this kind of quality of content, the deep analysis and understanding of the world around us. So if you click on the link below or go to realvision.com, it costs you $1. I don't think you can afford to be without it.
When the yield on the 30-year Treasury was 14.6%, it's now 2%. And you've had an unbelievable rally in Treasuries because, of course, as the interest rates go down, the prices go up. I said back then we're entering the bond rally of a lifetime. Why? Because I was predicting the unwinding of inflation. And I still think we're in that kind of environment. We basically have a situation where supply exceeds demand in the world. And when you get more supply than demand, what happens to prices? They go down. Now, this is not accounting for all the squiggles. And we've had some increase in commodity prices lately with bottlenecks and supply chain disruptions. But the fundamental facts are that Asia, China, and other countries are tremendous producers, but they're very weak consumers. They produce a lot more than they consume. So they have this excess saving, the savings glut, it's called. And that means on a global basis that you have more supply than demand. And that is what's holding down wages in this country. That's what's holding down prices. And sure, you look at things like P&G, they're just announcing price increases coming up in September because of commodity price increases and Kimberly-Clark and other commodity users. But I think if you look at it in any kind of a perspective, you see that we are in a low inflation, if not deflationary era.
And so, before we get into the nitty gritty as to why, what sort of asset allocation are you recommending to your clients? What are the key tenets and over what time frame?
Well, we're very cautious right now. I think you have a very difficult situation. The money that's been pumped out by the Fed and by all the fiscal stimulus, it is not really going into spending. It's going into savings. If you look at what people have done with the money they got last March and then December and again in this March, they've saved about 3/4 of it and spent very little. And of course, all the money the Fed has pumped out. So where's it going? It's going into asset inflation, and a lot of it into stocks. It's pushed stocks to unbelievable levels. It's really responsible for things like Dogecoin and Bitcoin, other cryptocurrencies, and all these speculations. And I think it's pushed stocks to unbelievable heights in relation to earnings or relation to anything else. And a result, I think stocks are very overpriced. Now, that doesn't mean that I want to be short stocks right now, because with speculations, you never know how far they're going to go. They leave the realm of any kind of fundamentals. They're off in the wild blue yonder. But right now, we are basically concentrating on relatively small positions in the dollar, long Treasury bonds. They've been doing better lately. We're short a few commodities like copper. But we basically have very small positions, and we have toeholds. But if things start to unfold as we think, and we get a big sell-off in equities, and it takes a lot of these speculations with them, I think we'll again have an opportunity to make some serious money.
Yeah, I think it's interesting that you mentioned Dogecoin in there as you said that, because we have internal meetings at the editorial group and Real Vision, and ultimately it's dominated by this whole thinking. The zeitgeist of today is around speculative assets. And Dogecoin, to me, is sort of the quintessential speculative asset in that it was conceived as a joke. Yes, the algorithm is basically the same as Bitcoin, but really, if people are speculating in what is a joke, what does that say about where we are and where we're going?
Well, it basically tells you that there's too much money floating around and people don't know what else to do with it. They're not spending it on yachts and furs, and they're spending it on single family housing, obviously in the suburbs and rural areas. They want to get out of the cities, but it is a speculative outlet with too much money. And it's a curious situation because the Federal Reserve, they can't be oblivious to what they're doing, but they are so concerned about employment and getting everybody back to work, even though you've had a lot of people, about a quarter of the people who are unemployed today have dropped out of the labor force. Matter of fact, the unemployment rate, it's registered at 6%, but it would be 8.8% if you had the same labor force participation rate that you had in January 2020. In other words, people are being paid to stay home with the checks from the government, the unemployment insurance, the extra unemployment insurance, and all the other government benefits. So you have a situation here where there's a lot of incentives for people not to work, and people aren't really spending; they're saving the money, and it's going into these rank speculations.
Because of that, I think I'm thinking about the Fed's dual mandate, because when you look at what the Fed does, they talk about inflation and they talk about employment as their dual mandate as given by Congress. But right from 1913, the Fed was told that they need to secure the monetary system. So irrespective of the congressionally mandated role that the Fed is supposed to play, they do have a financial stability role to play in the economy. And to the degree that this is going on, the question then becomes, how do they address that? Because it's you could call it a stealth third mandate that's always there. But if we see rampant speculation like you're talking about, is it possible that already in the summer, when we have a full reopening of the U.S. economy, that we're going to see a tapering of asset purchases and a renormalization of rate policy by the Fed?
Well, we very well may add. Certainly, there's got to be some end to this. Although I'm sure the Democrats will be pushing for a lot more stimulus going into the 2022 election, as you mentioned earlier. But it is a situation now where I think the Fed has lost complete perspective on this idea of what all this money is doing to the economy, and their only concern has been unemployment, and that's the same of Yellen as Treasury Secretary. But it's when you say when is this going to end? You remember they used to talk about the Greenspan put. In other words, the idea that there was a put to the Fed when Alan Greenspan was chairman, and then it was a Bernanke put, and then the Yellen put, and now it's the Powell put. In other words, these guys just seem like I know that they're very honest government public servants, but you'd almost think that these guys have got a vested interest in pushing up stocks and fostering speculation. But at some point, you would think that they've got to exercise more caution. But I'm not sure we're going to see rapid growth to the point that they make that decision this summer. I mentioned earlier, you've seen in these successive rounds of stimulus, people are actually spending less and less of that, according to the Fed's surveys. They survey people on a monthly basis and say, how much of the stimulus last March did you spend? And that was at 27%. And then in December it's 26%. And this March is 25%. So people are spending, and they're saving the rest. They're using it to rebuild assets and pay down debt. So I think the idea that there's going to be a very strong economy, so strong that the Fed is going to shift gears eventually, but I would doubt it happened by this summer.
Yeah, very interesting. The non-consensus view that you're talking about, and when you talk about the Democrats there, to me sounds like where you're saying, okay, we're going to have the full reopening in the U.S. just as we are in the U.K., perhaps this summer, and then elsewhere, slightly delayed. But when that full reopening happens, at least from the U.S. perspective, we're not going to have as robust a uptick as we want. And the Democrats, thinking forward to 2022 in the midterms, are therefore going to be forced to re-up on the stimulus, the same kind of stimulus that we've seen since the pandemic began.
Yeah, well, and of course, that could set off a battle between the Fed and the Democrats controlling the White House and Congress at some point. But again, I think we'd have to see a lot more growth before the Fed would shift gears. And in the meanwhile, yeah, we could get more stimulus. And where would it go? Go into speculative assets where it's gone so far. In other words, there's no until somebody blows the whistle, and that normally is the Fed. There's no real end to the speculative climate. It just gets more and more extreme. it's kind of like the socks the puppet kind of thing we saw back when the dot-com era in the late 1990s. I mean, absolutely no logic to the thing, but everybody's having a wonderful time as long as it lasts.
Well, interestingly, David Rosenberg, who we both know, I was reading his piece today for the morning, and he made the suggestion that when we look back to the dot-com bubble, really, it wasn't the Fed's tightening that was responsible for the collapse. It collapsed of its own weight, meaning that we reached a point of peak speculation that coincided with a number of companies not being able to make very prodigious earnings estimates.
Yeah, I think that's largely true. The Fed did start to tighten a tiny bit, but I think it largely did collapse of its own weight. And that certainly was true. That was truly of the subprime mortgage bonanza. I mean, that really collapsed when a couple of the mortgage companies, New Century was one of them, they basically reported lousy earnings at the end of 2007. And if you look at measures like of these tranches, one ABX, triple B minus, and some people might not know what that is, but it basically was a measure of what these securitizations of these subprime mortgages were worth. And that went from 90 to 10 in a matter of a couple of months. And that, again, that collapse of its own weight, that was not, as a matter of fact, at that time, the Fed and the White House, they all said everybody in the country ought to own their own house. And they were really egging the whole thing on. So, yeah, and maybe that's what we're going to have this time. It could end with simply it drops of its own weight.
Let's go back, since you're doing that. I think before we came on, I was talking to you about I can probably go back to the 90s. I can certainly go back to my first real experience in the market was the 87 crash. But I don't have any real historical in the moment knowledge of the periods before that. But we have a number of different manias or speculative bubbles. You mentioned a few of them: the internet bubble, the housing bubble. But what about the Nifty 50 and that period of time? What are your takeaways to this whole Mark Twain thing about that we can look back in history and it doesn't repeat, but it rhymes?
Yeah, as a matter of fact, interesting you talk about the Nifty 50. I was the chief economist of Merrill Lynch at the time. And I looked around and I wrote this up and I said, when we get to the point that the only thing that people want are gimmick cameras, Polaroid, motor homes, Winnebago, and amusement parks, Disney, and that's all they want. That's the outward flourishes. That's not the guts of the economy. And I wrote it up and I said, this means that people are rejecting the basic economy, that they're saying there's something wrong, that we're into speculation. And that's where we were then, and I think there are many similarities this time. How could this end? One possibility is that simply we wake up tomorrow and we find some major financial institution has bit the dust. We had this recently. This was Eros, which was I don't know whether that's just overpriced stocks or fraud or what, but. We can have something like that on a larger scale that just touches off the collapse. That's happened. You go back to the tulip mania in Holland in the 1600s, the South Sea bubble in England in the 1700s, and I've written up all this. I studied this extensively, and they all just get to the point where somehow. Some what looks like a tiny trigger and wham, they all collapse. So I think that's why in the portfolios we manage, we're being very cautious. We are really in a risk-off strategy, and we're prepared to step that up if things start to go in our favor. But I'm not making any firm prediction as to when this thing is going to collapse. The thing about speculations is they outrun any logic, and that's probably going to be true of this one. But at some point, boy, there's going to be a lot of blood on the floor.
In the interim, there's the real economy. Let's talk about the U.S. and then we can move globally, because that's the basis of earnings is the real economy. You talked about savings, but the event that's happening that's most salient over the medium term is the full reopening. The way I would describe it in the US and the UK in particular is we're getting to the point where everyone who wants a vaccine will have had one by, say, midsummer. And so we can reopen in a full way. A friend of mine who works at Deutsche Bank in London, he told me today was the first day that he was in the office for 5 months, and it was a ghost town, but this is what's coming for more and more workers. What happens in that period? What's the new normal potentially going to look like?
Well, first of all, the Dallas Fed has some interesting charts and information that suggests that the economy is now largely reopened. I think they're. I'm in New York. You're in Bethesda. I mean, there's certain areas where we may not be aware of that locally, but largely it is reopened. Secondly, when it reopens, it's going to be different. We're going to see more spending on services. That's what's been cut back. People not being able to go out to restaurants and hotels, travel, what have you. They've been home spending on goods. They've on Facebook, they've been ordering on Amazon and so on. So you're going to see somewhat of a reversal there in spending. I think there are going to be some permanent changes in people's work habits. A lot of people are discovering that going to the office and commuting an hour and a half each way is not exactly fun. I got to tell you myself, I moved our shop from lower Manhattan out to suburban New Jersey. And so it's a mere coincidence, it's 1.4 miles from our residence. I did that in 1990. I just said, hey, and interesting anecdote on that. That was back in the days when we all wore suits, and I would buy 2 or 3 new suits a year, not because they were going out of style, because I wore them out. Well, once we moved out here, I didn't have that problem anymore. And you think if that's what computing does to the suit, what's it doing to the guy inside the suit? But I think we're going to see permanent restrictions on office occupancy. People are going to be working from home part-time. And of course, what's happened is that the pandemic has made us aware of and really forced us to use the technology that's there. I mean, you and I might have well have been having this interview face to face if we didn't have the pandemic. We've done that in the past. Well, now we're doing it here, and I think we're probably getting along just as well as if we were face to face. So I think we're going to see a lot of changes there. Not that there won't be some reversion back to where we were, but only partially.
The big question then becomes, how do you play that, and how much of that's priced in? Because I'm thinking in particular when you say that about the Netflix problem, because Netflix had their earnings said, no one's watching Netflix relative to your expectations because we're reopening. And by the way, the numbers that we're going to give you for next quarter are even worse. And there's a big market reaction to that. So there's a hump that we're getting over where we're trying to figure out how much of this is all priced in and what the new normal is after the fact. And you're saying we're actually cautious. How do you be cautious in a way to be able to ride through this turbulent period where we're figuring out what the new normal is, but still have your powder dry to take advantage of the situation, 3 months, 6 months hence? I
think you just have to have relatively small positions. You take positions in where you think the fundamentals are going to go, but you don't bet the ranch until things start to move in your favor. That's my approach. I want a small position, and then I want the markets to tell me that it's working. Now, you can get a lot of false starts. There's no guarantee on this, but that's my approach. And if you look at example real estate. Our monthly newsletter, Insight, I bet last October, we did a major issue on real estate and noted that you no longer had everything in real estate moving together. It used to be that when the economy was strong, housing was strong, office occupancy was strong, people were going to malls, et cetera, a whole spectrum. Well, then it really changed because people were home. They were ordering from home on Amazon. Malls, a lot of the second and third tier malls basically went bust. They're trying to figure out what to do with the space. Hotels are in big trouble. Office buildings, in tremendous. So you had a real change on that. And I think that a lot of that is going to persist. Single family housing, of course, has been red hot, particularly people moving out of cramped, expensive city apartments into the suburbs and rural areas. There's been a huge increase in prices in that area. Builders have not really gone back to the kind of whole hog development that they did going into the subprime mortgage collapse. They've been a lot more cautious. So you don't have a huge overhang of supply that you had there. And you don't have the likely housing collapse, but you've had a big run in that area. So I kind of think that may be getting to the end where the bloom is off the rose. I don't think it's going to collapse like it did with the subprime debacle, but I do think that's probably getting about to the end.
Insight, how do we get, just for viewers, if they want to read your views, how do they get access to that?
Well, you can go to our website, www.agaryshilling.com, and that's all one word, AGARYSHILLING.com. And if somebody's interested, we'll send them a complimentary monthly copy, see what it's like.
Excellent. Now, when you are writing on your site about housing and commercial real estate, what are your views about how this plays out and how long it plays out?
I think that some of it is going to stick. That people are going to be more favoring single-family houses in the suburbs. You also have a lot of the millennials who are now in the home buying age brackets, although that's somewhat tempered by very low birth rates. There's a strong correlation between having young children and single-family housing, obviously. And birth rates have virtually collapsed. They've been declining for years, but the pandemic pushed them down further. So there isn't that strong motivation. But I think people have decided that they want to be out of the city. So I think that the single-family housing is going to remain relatively strong. But I rather suspect, investment-wise, that it's gotten ahead of itself.
Right.
Now, if you look at things like malls and office buildings, there you can argue that they've been oversold, that things have really collapsed to the point that there's that they are bargains, that they're worth looking at investment wise.
Yeah. Now, we haven't talked about Europe. We haven't talked about Asia, Latin America. When you look globally and you think, going back to your framework about non-consensus views, what are the things that you're thinking about in terms of the economy that people should be watching that is not consensus?
Well, I don't know that I have a lot of non-consensus views about Europe. Europe is recovering slowly from the pandemic, but Europe has been subdued for a long, long time. There hasn't been any great spark of growth there. You've had Brexit with the uncertainty with the separation of the UK from the from the European Union. As far as Asia is concerned, I think there's been an overemphasis on China in particular, a great fascination with China. China is the second largest economy in the world, but that's only because they got a lot of people. They got 1.3 trillion people. We got 350 million. I mean, they are a developing country. Their GDP per capita is 1/8 of ours. And the thing is that China is trying to convert from being led by exports and infrastructure. When they haven't got anything else to do with people, they build more roads and office buildings and have ghost cities and so on. They're trying to spur economic growth domestically, trying to get incomes up. And that means that their wages are rising. They no longer are the cheap manufacturing area. A lot of that low-end manufacturing has moved to Vietnam, Bangladesh, other cheap areas. So China is in a transition period. They swing a lot of weight politically and militarily with their Belt and Road policy and so on. But in terms of an economy, I think that the fascination with China is way overdone.
Interesting, and also interesting is your mention of the political and military side of things, because to the degree that you are caught in the middle, there's a temptation to, especially if you have military and geopolitical potential, to lean on that. And I'm not thinking just about the Chinese, I'm thinking about the Russians as well, who are busy building up military fortifications on the border with Ukraine. Do you think that any of these situations regarding China, regarding Russia, have economic implications? There's a potential that, there's an event there that roils the global economy.
Yeah, well, Shakespeare, and I think it was Henry IV, Part 2, had a great line that said, busy, giddy minds with foreign quarrels. In other words, if things aren't going well at home, stir up the monkeys with some kind of a foreign quarrel, start a war someplace else to detract from it. And I'm not sure that isn't what's going on with China, that they are, in some sense, detracting from their domestic problems and lack of growth potential domestically by getting involved in this sort of land grab in the South China Sea and their Belt and Road policy. They're spending a lot of money. They're getting very little results. But it is risky militarily. And Russia, the same thing. It's Putin is, let's go after Ukraine. Let's take on somebody really tough. Who do we take on? We invaded some Caribbean island a couple of decades ago. I've forgotten which one.
Grenada, was it?
What?
Was it Grenada?
Grenada, yeah, that was it. Yeah,
right.
yeah. I mean, we had a hard-fought battle with the Grenadian military forces. You put this stuff in perspective, and it's a joke. And it's a joke, but it's a serious joke because people's lives are at stake and things are disrupted. So I think you probably are going to looking at a world where you're going to see more of this kind of conflict. Let's hope it doesn't get out of hand, but it isn't going to go away.
Yeah. So Gary, if we had to wrap with things that we've missed, we talked about your non-consensus view, keeping your powder dry. What have we missed? What should people's eyes be on? And what time frame are you thinking about?
Well, I think it's a time when people are doing what makes sense. They're being cautious with all the stimulus money. They're rebuilding assets. They're paying down debts. Debts are still very high relative to norm. If you look at total consumer debt, and that's mortgages, auto loans, credit cards, student loans, you look at all that in relation to after-tax income, that used to run 60%. In the early 80s, it ran up to 135% in 2007, and now it's back to 85%, but it's still a long way from 60%. And I think that people are doing what they should. They're saving. Fed surveys show that 16% of millennials don't have $400 in cash for emergencies. And I think that we had a wake-up call with the pandemic, and people are doing that. So I think it is a time to save money, to be cautious, and certainly investment-wise to avoid these speculation. It's very hard when everybody is making money and you feel, I'm missing it. I'm here's this garage mechanic who's no longer fixing cars because he's making so much money in GameStop. I mean, I'm a stupid idiot. Why aren't I involved? Well, there are times when you really have to just pluck up your courage and say, no, I don't want to be involved.
Well said. One last question. I know that was supposed to be the last one. Long bond. What do you say about what should we do about that?
Well, I've been a fan, as you know, Ed, I've been a fan on that for 40 years. And And over that time, the long bond on a total return basis has outperformed the S&P by 6.5 times. 6.5 times. Now, a lot of people say, oh, well, Treasury's there for little old ladies and orphans. Well, I'll tell you, it certainly created financial independence for the Shilling family a long time ago. I think that yields are probably still going lower. You did have a little bit of a spike earlier this year, from late last year. Now we've seen a retreat in rates. I think rates are still going lower. I think we could get below 2% on the long bond. And the thing is that, if you have a 1 percentage point decline in a 30-year Treasury, you make about 20% on your money. It's called convexity, but it just means as the lower the rates, the bigger bang per buck. And if you have a zero coupon bond, one that doesn't pay interest, but you make it up through appreciation, you get about a 30% return. And to me, on any reasonable time frame, I think that's still a very good bet. Now, I'm biased. As you know, I've been a bull on bonds since 1981, when, as I mentioned earlier, I said we're entering the bond rally of a lifetime, and I think that's still running.
Well, yeah, that's the important thing. Let's do this again, update it, but Gary, let's do it in New York if we can.
Okay, yeah. Okay, that's a promise. We'll both get to New York. Okay.
Excellent. Great to talk to you, as usual.
Same here.
I hope you enjoyed this special episode of The Interview, the premier business and finance series in the world. However, this is just the tip of the iceberg. For more in-depth content and expert analysis, visit the membership link in the description to unlock a week's access for only $1. This dollar can change your life.